I'm Ant Gould for AM Best TV at the Insurance Market Briefing Europe in London. Now, illiquid assets have been growing in popularity, and to talk about their new report on the issue, I'm delighted to welcome Tony Silverman, Associate Director, Analytics, AM Best. Tony, welcome. So the report refers to evidence of increases in insurers' holdings of liquid assets. What's been driving that trend?
Well, there are some actually quite strong drivers which have got us into this position where, if you like, post the 2008 financial crisis, which had a lot of liquidity issues in there, insurers are actually now looking to hold more illiquid assets than ever before. And there are low interest rates are a defining influence, but it can't just be that it's low interest rates, because there are a variety of responses to that, and there has to be an attraction in the illiquid assets space for insurers to react as they have done. And there are various strands to that. I'll mention just a few. There is an acceptance, really, of the argument that because the universe of investors is far more limited for illiquid assets, that insurers can actually expect to get paid extra for holding them. And that has begun to be recognised in financial reporting as well. So if you consider in Solvency II, for example, the matching adjustment and to a degree the volatility adjustment, and the discount rates that one might expect to see under IFRS 17, these are all in excess of risk-free rates, and insurers CFOs could reasonably ask, how is what we're going to get, how does that compare to the return assumptions in the financial reporting? And there's a collection of other reasons as well. There was an expectation that underwriting profit would react directly to low interest rates, but it's been squeezed. It moves around a bit, and it may be moving around, it may be looking better going forwards now, but it's failed to react directly to low interest rates. And then there's the question that a lot of assets have moved from the public listed markets. They've migrated to private markets. And if you don't follow them, then the nature of the assets you hold changes by default. And finally, insurers have been involved with illiquid type assets, for example, commercial property, for a long time. They have skill sets there. And the question is trying to maximize or optimize the use of those skill sets. So that's something that this exercise also involves.
So we've got a good idea and a good picture of where we are at the moment, but how's this going to play out over the next 5 years?
Well, we were very interested in that, and we have surveyed our clients. We got an excellent response referencing, this is just a survey of European-based insurers. The survey really referenced over 3 trillion euros of assets, excluding unit-linked. And the answer was really quite clear, that 50% of insurers, I'll put it this way, representing over 90% of the assets of the sector, are looking to increase their holdings of illiquid assets as a percentage of their total funds, excluding unit-linked. And that's 25% of those, representing 65% of the industry's assets, are looking to increase the allocation to illiquids by between 5 and 15%. So we're looking at a highly visible change which will change the complexion of the investment process, really, for the sector if it plays out as we're expecting.
And as you say, that's a very large increase. I mean, how on earth are insurers going to drive this? Are they going to do it themselves, or have to get specialists in, or use third parties?
Well, again, yes, we asked this question in the interview, and this sort of change presents an implementation challenge on all sorts of levels. And the responses, as you might expect, did vary between the unweighted sample, that's just, if you like, one insurer, one vote, and the weighted sample, weighted by investment assets. And whereas the 50% of insurers said that they would expect the majority of their assets to be managed and sourced internally, the weighted sample was over 90% direct. But that varies between segments. And if you look at the different asset categories, then for the unweighted sample, they're looking to they're mostly indirect across all the categories. That's infrastructure and commercial property, equity and debt related for those two categories, equity release mortgages, private debt, private equity. And there is a single exception to that, which is commercial property equity, where the weighted sample is looking to manage that directly for the most part. But if you look at the weighted sample, weighted by investment assets, then it's all the other way around, certainly for the infrastructure and the commercial property categories. They're heavily represented by direct management. The larger insurers are looking to do that directly. And this does raise the question of whether an industry-wide move to illiquid, to allocate a bit more, 5 to 15% more, to illiquid assets, it amounts to a challenge and a competitive disadvantage for smaller insurers. Now, I'll just finally say that one interesting thing is that if you look at the weighted sample for the final three categories, that's private market debt, big category, private equity and other assets, and equity release mortgages, which is a specialist thing, then the weighted sample, I should say, looks much more similar to the unweighted. And in fact, even for the weighted sample, in those categories, insurers are looking to do more in the indirect third-party managed space than managing directly. And it appears to be that for those categories, there's it's really hard to replicate the expertise and the accumulated history, if you like, of the third-party managers. And it also means that in those segments, the smaller insurers would not be at any disadvantage compared to the major insurers. And it may be that private market debt is something that smaller insurers, perhaps it's surprising they're not doing more of that, actually. So the implementation does vary across segments with the direct insurers looking to do it directly, the larger insurers looking to do it directly.
Thank you very much, Tony, and certainly some food for thought there. I'm Ant Gould for AM Best TV at the Insurance Market Briefing Europe in London.